So if you've been watching the news lately or reading the internet, there's been some discussion around loan level price adjusters, some changes that are essentially coming to the mortgage industry that may cause some shakeups for some. Specifically, like I mentioned, this is loan level price adjusters. Think of this as a risk-based adjuster. For an example, if you are getting health insurance and you're a smoker, you're going to have a higher rate than someone who doesn't. This is the case that if you're, it's based on your credit, your debt to income ratio, and so on. So we want to clear some air and provide you with some information for exactly what this all means for you, the home buyer. So with me, I have Phil Kresge, who is a loan originator from Benchmark Mortgage, to provide some breakdown for you. My name is CJ Sabo. I'm a realtor with Better Homes and Garden Real Estate Valley Partners. So we're going to jump into exactly what this means for you, clear some air because there's a lot of misconceptions out there, lots of graphics, for example, a heat map that may be confusing for some people as well. So we want to just break this down, provide you with the information, exactly what this means for you. So Phil, thanks for joining me today.
Yeah, it's my pleasure. Thanks for asking, CJ. This is a great idea. You're right. That heat map kind of piece that went out is really confusing. It makes people think, oh, wait a minute, I'm getting a better rate by this much if I have a lower credit score. And that's emphatically not the case. You're always going to have a better score for a better interest rate if you have a better credit score. But so, to kind of explain it, I thought the place to start might be to first just kind of say, like, what is a loan level price adjuster? Because you'll hear me refer to them as LLPAs. That's what we refer to them in the banking industry for jargon, because who wants to say all four of those words every time we're talking about it? I put a little chart together. I'll move us down to the corner here to kind of show this for you. So this is what a rate sheet looks like, okay? And this over here would be a base price rate sheet. So base pricing changes every day. When people say rates change every day, what changes every day is the base pricing, and that is as it relates to the mortgage bond market. Mortgage-backed securities trading in the secondary markets, values there, and that'll change these base pricing charts. Now you can see, and I've described it before as thinking of an XY axis. Coming up the Y axis, we've got the different interest rates, and going along the bottom here, we've got how long you would lock the rate for. Now, in all of these boxes that are in between, this is actually a price, these numbers and decimal numbers. And it's a price that's charged or credited based on a percentage of a loan amount. So this isn't actual interest rates today. I think it's important to mention that. This is something that I put together and just, gave a spread. But when you look at this, if there are no price adjusters at all and someone was just on base price, right here we've got this 6375 on a 15-day lock. There's no price there. That's what would be considered a par rate, a rate that isn't paying anything, doesn't cost anything. If somebody wants to buy their interest rate down, they can buy discount points and buy their rate lower. And so people have heard of discount points. That's what that is. So if I was at 6375 in this example, and I wanted to buy 6.25, it would be a half point, 0.5%. And that's 0.5% of the loan amount. Yep. So if I had a $200,000 loan amount, and I wanted to buy my rate to 6.25 in this example, it would be $1,000 in discount points. That's an additional closing cost to me as the borrower purchasing the home. Like on the converse of that, not likewise, the opposite of that. If I accepted a rate that was higher than the rate that I qualify for, my par rate, I would get paid money by the bank for accepting that higher rate. And it's called lender credit. It's another term people have heard of. Oh, can you get a lender credit? Well, know that if someone says, can you get a lender credit? The answer maybe isn't necessarily yes. I don't know. What's the pricing? I mean, that's literally the pricing for the rates. So, you can get one by accepting a higher rate always. Outside of that, you would need an exception from the bank, and that's, maybe you could get it, maybe you won't. It depends on how much was needed, what was being asked for. So if you accepted a rate of 6.5, it would pay a quarter point toward closing costs, $500 less to the borrower out of pocket in that same $200,000 loan amount example. So LLPAs are the adjustments to the base price sheet. And as CJ had mentioned, those are risk-based.
Yep.
So up here, this is, again, an example. This isn't exactly what they are, and it's a little more, when we look at the heat map, you'll see it's a little more broken down than this. But this is an example of like how those get applied. So if I had a credit score of 690 and I was putting down between 5% and 19.99%, I would have a half point adjuster to the rate chart. Then down here, these ones are non-loan to value or credit score adjusters, where like if I have a second home, that's more risk. If it's an investment property, and another reason you can see these are more risk, a second home, minimum down is 10%. For a primary home, first time buyer, you can do 3% down. There's also great first time buyer programs, help people with that stuff too. If I'm doing an investment property with one unit, the minimum down is 15%. And if I'm doing a 2 to 4 unit, the minimum down is 25%. And you can see these adjusters here that continue to adjust the interest rate higher the more risk that's being added on. Some states, the state that you live in has an adjuster that could make it higher, also sometimes a little bit lower. If you have a condo, that's higher risk because like if people don't pay their HOA dues, well, now the condo's unwarrantable, so that's a risk for the bank. Refinancing is a risk, especially cash out refinancing. And a new one that's coming in, I left as a question mark. Also with these changes to loan level price adjuster, there's going to be an adjuster if you have a high debt to income ratio. Debt to income ratio being what's the monthly payment of the home that I plan to buy, and what's the monthly payment of all the various items on my credit report compared to my income as a percentage. So I'm pretty sure there was like a little bit of a peak on it, and then they said, we're having a little blowback on this. We're gonna hang on to rolling out that one right away. I think that's gonna roll out like at the end of the summer. Yep. They're not really being exact on the date, but toward the end of the summer, and then that will jump in too. And it looks like if you're over 40% for your debt to income ratio, you'll have another 0.25 adjuster, but that's just like kind of a peak that I got about it. And it's not, they might change it when they roll it out. Cause again, they started and they were like, whoa, everybody, hang on. We'll hang on, we'll hold off on that one. So I left a question mark. I don't know exactly what it will be. But so to kind of just show you the example here, I can do a total LLPA in this box. So I said, 690, 15 to 19% down is a half point. And then let's also say it's a second home. That would be 1 point for loan level price adjuster. I'm going to come over to this sheet here. So if I do 1 point in adjuster, you notice all of these just shifted. So now, the par rate would be, 6.75, that 0.05 is very small discount point. And that's something where I'd mentioned like, you can do some exceptions if you've got some kind of small that thing, because you don't necessarily want to show discount points on every single estimate that you do. Sometimes it makes sense for people to buy down, and I'll try and show round numbers on that because the interest rate sheets, they change every day and they're not perfect that way. There's not always a perfect par rate. So that might be, I'd show this 6.75 as a par rate. And if someone wanted to buy down from there, it would be a half point because I'm already doing a 0.05 like bank adjustment. So it would be a half point to go to 6.625 and so on. If you're doing an investment property and you're doing, let's say you're doing 2 to 4 unit investment property, you have to be at least 25% down. So also say you're a 690 again. So that would be 2.5. So we'll go 2.5. We come all the way up here. And that's where someone might see the difference of, if I'm buying an investment property with my credit score compared to if I'm buying a primary home with my credit score, why is the interest rate so much higher? Because there's a massive adjuster, especially right now when COVID happened, the adjuster for non-owner occupied properties got larger than it was and set that pricing because there's just not a lot of appetite for risk right now. If it was a 2 to 4 unit investment, if it was just a primary residence, same scenario, it would just be 0.25. Your rate's all the way down here. So that's the look of what's a loan level price adjuster. Now, the other thing that we talked about was that heat map chart. So I have that here, and I'll pull that up.
And what was unique with this is it made it seem that those with lower rates were getting a better rate than those with the higher rates.
Well, yeah, without the knowledge of what this is really saying, you look at it and you go, wait a minute. So if I'm doing, 5 to 9, almost 10% down with a 640 credit score, I get 0.875 better in rate than someone with a 740.
Yeah.
And their rate gets worse by 0.375. And the percents are there too, which makes sense because you charge discount points as a percentage of the loan amount, as I described before. But this isn't saying that the interest rate is going to be moved by that. It's the prices in these boxes that are moved by that as a percentage. So really what this chart is doing is it's saying, okay, compared to how things were before, after this change, the adjusters are going to get better when it's green and these yellows, red is higher LLPAs, and the negatives, meaning it got worse as compared to before, and then the lower means it's getting better as compared to before. So then you might ask, why would people with higher credit scores be having this type of adjustment? And that really is also driven by the market right now. Right now, prices of homes got very high, a lot of competition and not a lot of inventory. People were paying over on houses like crazy. I'll bring 20,000 over and don't worry about if it under appraises, I'll cover it, right? No inspection, all of that. So competitive, it drove the price up a lot. And then, the next home that's going to appraise down the street when it's for sale, it's going to use this other comp. The appraiser's not going to know necessarily that this person paid over what its appraised value was. They just know what it sold for, and that's what sets the market. That's why all of a sudden the house down the street's worth so much more too when this one sells for $25,000 over value. What this did was basically take it so that, let's say, before this change, if you had a high credit score and 20% down, your rate would be 6.5. And if you had a low credit score and 20% down, your rate would be 7.5. This change has taken it to a place where it would be like that high credit score would be 6.75, and the low credit score would be 7.25. And it just kind of brought the edges in a little bit. And it did that because people with a lower credit score also tend, and this is not everyone's true for this, but the data shows that if someone with a lower credit score tends to also have a lower income, which may be why they missed a payment on something, or they carry high leverage on credit cards, and these things can bring your credit score down, where someone with more income tends to be people with a better credit score, more money down. So what they did was said, okay, this area here is an area where people tend to be more qualified. We're going to hit the rate there a little bit so that we can give a break on the rate where people are less qualified and help keep a bigger market of buyers available to get loans. That really was the driver. And there's a lot of stuff, if someone's doing 30 to 60% down, none of that changed. And except for someone with a lower credit score, it got better, which, if you have a lower credit score and you're doing 60% down, that's like the type of deal like, hey, I own 5 businesses and one of them went bankrupt 3 years ago, and got out of that. It's like, okay, these people can afford the home, this is going to tend to be where just that aspect of it is probably what's wrong. And even on the highest tier credit score, it really only got worse when you're between 85, 15% down and just shy of 20% down. And then these are actually, that other chart that I showed where I said it's actually more expansive than this, these are the breaking points for all the different loan level price adjusters as they relate to credit and loan to value ratio. Those other adjusters didn't change. They're still the same as they were before, except for it's adding in that debt to income ratio adjuster. So that's really the change itself, what it really is. So if anyone is out there talking to someone, I talked to a credit repair specialist who said, so wait a minute, when I'm trying to get people the best rate, I need to make their credit worse now? And I was like, so glad you asked me that question before you talk to someone, because you should absolutely still always a better credit score, more money down, you are going to have a better rate than less money down and a lower credit score. That is still the case because it's risk-based. That'd be like saying, oh, we're going to sell, your health insurance example was great. I'm going to sell health insurance. I'm going to make it cheaper for people who are more likely to die soon with young kids. That makes absolutely no sense. No one would do that.
Yeah. All right. Well, thanks for all the information. There's definitely lots to take away from this. So definitely want to get your thoughts. Leave a comment. What do you feel about this? Does this impact you in a positive or possibly a negative way? Leave a comment. Let us know. Thanks for joining us.
Thank you. Call CJ for a house.